Hims and Hers reported earnings after the market closed on Monday, and results were really phenomenal across the board. There was a lot of really good news for the company, not just about GLP-1s, which has gotten most of the media attention in the last quarter, but actually the entire business is doing well. So I want to dig through the results, the kind of growth that we're seeing. Not only did management beat expectations for the second quarter of 2024, they raised guidance for the full year of 2024. So good news all around. Now, interestingly enough, the stock was down after hours. Seems like it closed up a couple hours later. So we'll see where things open on Tuesday. I'm recording this late on Monday night. But everything that I saw was positive for the company. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get right to the numbers. Here are the numbers on a high level. They give the quarterly numbers for Q2 2024 and the big numbers here, and then the year ago numbers on the bottom if you want that reference. 52% growth to $315.6 million in revenue. So just a phenomenal growth rate for a company of that size. And remember, Hims has a market cap under $4 billion. So that price to sales multiple well under 4 given this revenue level and the growth rate. Net income, the company has finally swung to net income in the last couple of quarters. Adjusted EBITDA was up 270% to $39.3 million. And then these cash flow numbers, this is what was really impressive. Operating cash flow $53.6 million and free cash flow $47.6 million. The company actually announced that they had completed a $50 million share buyback program, instituted another $100 million share buyback program. Now, one of the challenges with that is part of what they're doing is offsetting dilution from stock-based compensation. So I certainly don't want to see that. Just spend the money on employees rather than giving stock, but that's a story for another day. The number of subscribers, 43% increase to 1.9 million, and monthly average revenue per subscriber up 8% to $57. These are really the two numbers that are fundamentally going to drive the business, is the number of people who are in the system on the platform and then the amount of money that they're spending. One of the things that's gotten a lot of focus in the last few conference calls is the personalized products that Hims and Hers is making. This is really one of the differentiators for the company. So as they get to know you as a customer, they get to know what type of medications you like to use. Would you rather have a pill or a gummy? Is there two things that they can put together into one treatment? This is the kind of personalization that they can do that you're not going to get at a traditional pharmacy. And those personalizations, now about 40% of all the subscriptions that they are delivering. So phenomenal growth there. And like I said, that is a point of differentiation for them. Here's just a highlight of exactly what I just said. Approachable form factors, different dosages, and then also multiple conditions per offering. They did announce that they are acquiring a 503B sterile compounding facility. So that's going to be able to give them increased offerings. And they're really just building out that infrastructure for the business. So you have a platform, and that's the digital platform connecting with doctors, getting prescriptions. That's what the customer is actually going to see. But then actually on the supply side, that's just as important to be able to bring those customized solutions to customers, the lower costs that we see from Hims and Hers. That really comes down to what their supply chain looks like and what they brought in-house. So I think a good strategic move for them and is going to enhance their capabilities and what they could bring to customers long term. Their financial outlook was increased. This is the new current fiscal year outlook, $1.37 to $1.4 billion in revenue, adjusted EBITDA $140 to $155 million. The previous outlook was $1.2 to $1.23 billion in revenue and $120 to $135 million in adjusted EBITDA. So significant increase in the expected growth rate. And they highlighted a number of things: more long-term retention, extending the portfolio with more personalized offerings, strong unit economics with paybacks from new products for under a year, and they're getting marketing efficiency. So the customer acquisition costs is starting to go down as they get more efficient on the marketing side. And here's just a look at the historic numbers from a subscriber perspective. You can see that since Q3 2022, the subscriber number has more than doubled, and the revenue per subscriber is actually pretty stable. I don't think that's something you necessarily need to see growing at a really rapid rate. as long as your subscriber number is growing. So this is going to show more the affordability that they're bringing to customers and people coming in the door and staying a little bit longer than maybe they expected previously. The margin profile is also really strong. Gross margins at about 80%. So even though they're offering lower costs than a lot of their competitors, still have a really high gross margin, and they're maintaining that margin as they grow the business long term. Where you're starting to get that free cash flow and profitability is because of operating leverage in the business. This is just the GAAP operating expenses and non-GAAP operating expenses. You can see that marketing is the biggest thing here. And this was always my question about Hims and Hers before I added it to the asymmetric portfolio was this company on a customer acquisition treadmill where you just have to spend more and more money to acquire customers? That has really changed course. And now they're spending less money on the customer acquisition from 51% of revenue a year ago to just 46% in the most recent quarter. That number should continue to go down as this becomes a more common name, a more common place that you would search for solutions you might be looking for, rather than them having to come to you from a marketing perspective. You're basically just reaching economies of scale with your marketing at this point. And finally, operating cash flow in purple, free cash flow in gray. You can see those numbers are going up and to the right. That's exactly what you want to see. And then cash and investments, $227.3 million. Like I said, they did spend money buying back stock in the most recent quarter. So this will fluctuate over time, but they are returning that cash to shareholders. Seems like they don't think they need a lot of capital to continue to grow the business. So they're going to be aggressive in potentially reducing that share count. Like I said, some of that is offsetting stock-based compensation. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There were a number of questions on the conference call about the company's compounded solutions and the durability of that business long term. You might remember that there was a short report earlier in the quarter that really questioned, could the company's, particularly GLP-1 products, actually be sustainable, because they're being made under basically a loophole in the FDA where if there's a shortage of a product, you can actually compound those solutions. Management, I thought, answered those questions pretty well. Seems like they have a good understanding of how long these shortages are going to last, how long they're going to be able to build a business on top of this. And then there's a pathway to generics, to branded medicines in the future. So certainly seems like the kind of thing where they're building a platform that is going to have multiple solutions. Some of those solutions in the future will be compounded. Some of them will be from other branded solutions, but they're really doing things differently than the traditional healthcare system. And I think that's what's fundamentally different about Hims and Hers, is they're cutting out a number of the middlemen. Wouldn't be surprised in the future if you could go straight from your doctor to a Hims and Hers subscription, get that delivered straight to your door. That could be a good solution for everyone involved. So I thought it was a really solid quarter in the second quarter. It'll be interesting to see the market's reaction on Tuesday. Any dips, I'm definitely looking at as a buying opportunity in Hims and Hers, because I think the numbers just look absolutely phenomenal. It's not often you come across a company that's trading for only 4 times sales, and yet sales are growing at 50% plus. So phenomenal performance from Hims and Hers. And I think this is the kind of company I'm going to own for many years to come. But what do you think about Hims and Hers and the results? Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.